The content presented today is not directed to any investors or potential investors and does not constitute an offer to sell or a solicitation of an offer to buy any securities. And with that said, it is my pleasure to introduce our panel for today, which consists of Steve Bennet, LP, Ihar Mahaniok, Managing Partner at Geek Ventures, Alex Zorychta, Managing Partner at Not Yet Ventures, and we also have a founder for this event, Barbara Belvisi, co-founder and CEO of Interstellar Lab. Maybe let's start with you, Barbara. Please introduce yourself and give some background on how you got started in this industry and what you're doing right now.
Sure. Hi, Nils. Hi, everyone. Very happy to be with you today. I'm the founder of Interstellar Lab, and before Interstellar Lab, I was actually a VC. So I come from the dark side. No, I'm kidding. So I started my career in finance, from portfolio management to private equity to venture capital. Started my own fund when I was less than 30, 26, 7, something like that, and invested in deep tech companies, mostly hardware companies. And in 2018, between 2017 and 18, I'm not an engineer, but I got trained at NASA Ames, the space portal, learn about controlled environment system, and I started Interstellar Lab, where we're a startup, seed stage, building a controlled environment module to grow plants on Earth and in space. Voilà.
Wow, that's very interesting. Next up, Alex, why don't you go ahead and introduce yourself? You're muted, Alex.
Yeah, absolutely. Alex Zorychta, the C is silent, but no worries
okay.
on that. Yeah, no worries. Managing partner of Not Yet Ventures. I've worked with university entrepreneurs for the last 12 years since I was a university entrepreneur, both on the co-curricular side of developing programs to actually help entrepreneurs at these universities start companies and actually succeed. And then actually as a professor of entrepreneurship, teaching hundreds of students, I've helped 14 of these companies get funded by Techstars and Y Combinator, which is pretty awesome. Because I was out of the University of Virginia, which is not known for its entrepreneurship. And I did this by developing a method of quickly finding the high potential entrepreneurs before they even had the idea, and then helping them succeed from there. I was most recently with Amazon Web Services in their startups business development division, where they hired me to actually do this on a larger scale, working with 200 universities. And I realized that this was basically what a VC does. So I decided to get started with Not Yet Ventures.
Very nice. Next up, we have Ihar, who is a bit more experienced as a general partner.
Thank you, Niels. Yeah, I'm Ihar Mahaniok. I run Geek Ventures. Geek Ventures was founded about 2.5 years ago to invest in immigrant founders at early stage. We announced that we already raised our first fund of $23 million. Before Geek Ventures, I had an angel investment experience of more than 10 years. And 5 of my companies went from seed to unicorn. 1 went from seed to IPO, which is Instacart, and I got about 15 exits.
Thank you, Ihar. Steve?
Good morning, all, or afternoon or evening, depending on where you're zooming in from. I'm Steve Bennet. I'm in California. For the last over 3 decades, I've split my time between teaching entrepreneurship, investing in startups and funds, and then taking operating and board roles in startups. And full disclosure, I'm a investor in VC Lab and also in the fund of funds Decile Capital. So, big fan of VC Lab, and have been a mentor and speaking at these events from the beginning. So on the LP side, I've invested in around, I think I counted 29 funds, so pretty active in investing both individually, and then our group, I'm part of Sandhill Angels, and we're also an active investor in startups and funds. And I've been with 2 funds and started 2 accelerators in the past as well.
Well, so yeah, you have, as you mentioned, you have 3 decades of experience. How have you seen like the industry evolve over the years, and what's your feeling about the current market?
The venture industry evolve over
Yes.
that time. Okay. Yeah, so I mean, it's definitely changed a lot, because when I started in this in the late 80s, early 90s, there were a known number of firms on Sand Hill Road, mostly institutional LPs doing series A, B, C investments, and a pretty clubby atmosphere there. And then that was probably fairly similar for kind of the next decade or two. And then certainly now we've seen the emergence of smaller funds, micro VCs, angel groups, syndicates. So and definitely a lot more global. So most of the investments, the majority, were all done within 30 miles of the VC's offices in Sand Hill Road when I started. And now, of course, everything is, we have remote, we have global investments, we have, more single GP funds. So, I've seen the first fund I invested in was back in the late 90s, Angel Investors LP, which was an index fund of internet investments. And fortunately, it was a good example of the power law. Google was one of the investments in the fund, so I'm still holding some Google stock at a basis of 20 cents a share. So that kind of shows the power law. But what I've looked at more recently, and I want to kind of pass it along to others, is I think it's a really interesting time for emerging managers, and looking at a very a good sized group of small funds and managers that have been operators, and are doing some pretty interesting things.
Thanks, Steve. That's very interesting. Yeah, we talk a lot about vintage year 23 and how it's, according to us, it's shaping up to be a very good year. And we have two GPs who are currently raising funds in this environment. I don't know, Alex and Ihar, if you can share some more about what you're seeing in terms of investment opportunities in this market.
I can start as more from the focus on deploying. So I'm since I'm always talking to LPs, and I think everybody should be talking to investors all the time. I'm not officially raising because we just finished raising the first fund. On the what I see definitely on the other side of the equation, on the deployment side, it's still the best time to deploy, because there is not as much competition from investors for the few startups, and it's still investor-friendly environment from the perspective of investors and founders, right? So it's definitely a time when you can be very careful and thoughtful in due diligence, as opposed to sometime in 2020, 2021, when the founders would rush you to make a decision in one day. And now you have time, always, several weeks to do your due diligence. You can negotiate properly, and you can pick companies that already have proven something. Otherwise, you can, if you want to work with early stage, idea stage companies, the valuations are very, very reasonable for you to preserve upside. So I definitely see that, and that's what appealing to a lot of LPs who are not completely risk averse, right? So that can invest in this environment. And we also see some liquidity opening up in the market from the perspective of a few IPOs, and the markets, the public market stabilizing for the last 6-9 months, let's say, and that allows a lot of LPs to feel, especially individual LPs that are relying on like stock market as their own liquidity, that they become much more open to invest. I remember when I was fundraising starting like end 2021, early 2022, and the worst environment for fundraising was that second quarter of 2022, because the things went down so fast that everybody was extra cautious. And then throughout 2022, it was still tough. 2023, the main thing for raising for VCs became that LPs, especially individual LPs, became much more, adapted to the environment, let's say, right? So stocks went up. Stock market doesn't seem so volatile. So which allows them to feel more comfortable to sell stocks and invest in new alternative investments like VC funds.
So you touched on something very interesting there, and basically that 2023 is looking very differently than end of 2022. Barbara, in your experience as a founder, is that something that rings true?
Yeah, it's very true. 2022 was a nightmare to fundraise. So if you there is a bit. Okay, I was frozen for. Yeah, I'm back. So it was not very easy to fundraise. Like, we are in between United States and Europe, so there is a bit of delay. US is 6 months to 8 months ahead of Europe. So Europe is still catching up. So we can. Last year was like really hard to. Everything was very slow. We just started raising the Series A. And I can tell you that it's very responding. You get your first calls very quickly, and the market is there. So definitely investors, I think, have money to invest before the end of the year. That's a feeling that I have doing calls right now. And I think it's a good time for entrepreneur to fundraise, especially if you pass through the crisis. The company who survived 2022 and show in 2023 early revenue and focused on, like, how do you make money without getting the money from investors? I think right now is a good time to go out, because there is money that wants to be invested. So
interesting. So as a founder, how do you bridge periods like that? Are you trying to delay the next fundraise, waiting for better conditions, or is that a luxury not a lot of companies have?
So I'm a risky entrepreneur. So I don't slow down the company, but I will operate on the low visibility on cash flow.
Okay.
So I will go down with the team. Okay, what do we need to achieve to reach this next milestone? So we're not slowing down the activity and getting to market and getting to customers and investing in the product. It's very down to cash allocation. So I always keep the cash for the team, and then negotiate payment terms with your suppliers. Because they can wait a bit more. The team cannot wait for their salary. So it's pretty much when you're in a super stressful cash situation. As a founder, I put myself in low cash. Well, I've been always like this, but low cash management. Keep on moving forward. I'm a huge believer that if you keep moving forward and keep investing and like developing your product, then you're going to attract your customers and the market's going to follow. If you slow down too much, it's going to be so hard to fundraise. Like, you're just like stopping everything and then you're asking for money for investors. I really don't believe in that. So it's risky, but that's my advice to entrepreneurs, like, to keep pushing.
Okay. And yeah, I think the same applies to fund managers as well, right? I think Ihar, this rings true for you a lot as well. You're someone who never stops raising, always keeps moving. Do you ever adapt your strategy to downturns, or the opposite?
So I think that what's important is to understand who you talk to and what you talk to them about, right? So because, of course, one of the important messages that really I think we should keep talking about is like, what is the investment environment that you will work with as a VC? Because every LP is curious, how are you gonna invest and deploy their money, right? And deploying money in the down market is a little bit different from deploying money in the up market, right? So I still believe that VCs can be successful in any market, right? And the serious LPs deploy every year, regardless of the market conditions. But one of the things that I could recommend to other GPs is like, think about how you can utilize the down market effectively for you and your LPs, right? So like find startups that are promising at lower prices, utilize an investor-friendly environment, right? So, and that's important to talk about in the down market. It's also important to understand individuals, right? So in the sense that, for example, one of the problems I found in 2022 and 2023 is that people who are employees at pre-IPO companies, they cannot commit because they don't know when the IPO will happen. So for them to open up liquidity, right? Back in 2021, 2020, the situation was much more different for a lot of these pre-IPO employees. So.
And you've mentioned IPOs a few times. The IPO market, like 2022, almost dead pretty much. We're seeing signs of improvement, but do you have any estimates in terms of like when the IPO market may be open for business again? And everyone feel free to answer this one.
I think it's going to be a while.
Okay.
You're going to have, you know, some probably this year and in 2024, but I would think it's going to be probably 2025 before you see, you know, material improvement. M&A activity will probably pick up, I would think, in 2024.
Okay, well, what would be driving that?
The M&A. I mean, I think
Yes.
there's, you know, we're seeing, and again, this is something from the LP side. So distributions have, you know, have gone down dramatically, which obviously has an impact on recycling and putting money into new funds when you don't have money coming out of older funds. So I think, you know, one side there's going to be kind of, you know, more pressure to get some liquidity and get some distributions. And then also I think the, you know, the business environment's going to pick up, and M&A typically will precede IPO activity.
Oh, thank you, Steve. Alex, you're one of our more recent VC Lab alumni. How is it like starting a fund in this environment?
Honestly, I don't think I could have picked a better time. If you think
Nice.
about Ihar, I don't know how you did it, right? 2 years ago. If you're looking for, you know, early companies, right, trying to find those great ones, investing in them then, and then getting to this market as they're getting to those next rounds must have been super difficult. So the fact that, you know, you're super successful, right, at finding these, just a testament to how strong your fund is. So I feel like I got it easier, you know, in this environment. As you mentioned, you know, deploying is easier, or will be easier, because the startups that are surviving, even getting to this point, the fact they're making traction, they're doing more with less, means that you're going to find better companies. This has been shown in the last couple of economic downturns. You know, like Airbnb was started during the economic crisis, right? So there's been a lot of history of that. But the reality is, the best startups, you're going to be competing for those deals, right? Because the best startups are obvious. It's just that a lot of the crappier deals are going to be gone and not on the table. And so for you to really be able to provide value for your LPs, as Ihar was saying, you need to be having that unique angle to find those deals that aren't immediately obvious as the ones to be investing in now. If you can find those during this time, then it's great. So I'm excited to be building this fund in this environment.
I want to agree with Alex on that, right? So that the investors who have had experience working over the last several years, but are only starting to deploy money from their new fund now, can like avoid all the mistakes, right? So that could have been done on this like 2021 or are going to change, right? And we don't know how long will the environment that's today last. I don't have a crystal ball on what will happen exactly in 2024 and 2025. But what's important is that there are way fewer companies raising money while not knowing what they're doing. Or if they are trying to raise money, they are not able to, right? So, and we see that really, really good companies that if they are able to raise a fund, even a round, even if it's a small round, like $500,000, it means that they have dotted their I's and crossed their T's really, really strongly compared to a lot of companies of a boom cycle.
Okay, we've seen sort of like a great filter happen in 2022, and it's more clear where the quality lies right now. That's very interesting. Yeah, let's maybe take a question from the chat. We have a question from Abdel. Are asking, what are your thoughts on the recent PitchBook report, which suggests that limited partners show greater interest in established VC firms with a strong track record as opposed to new managers? And do you think this trend might be indicative of a potential market slowdown in 2024?
I guess I can
Yep.
take that. I haven't actually seen that PitchBook report. I did see one they came out with last week that said VC fundraising activity was down 67%, and they didn't see that recovering anytime soon, which I think goes against a lot of the emerging manager data that we're seeing through through VC Lab. But oh gosh, I'm sorry. What was the specific question again?
Basically, it's about why would
emerging versus established.
Stuff.
Yeah. So I again, I haven't seen the report, so I don't know the data, but anecdotally, I would I look at the reverse from my own experience. First and second funds have outperformed subsequent funds, and I think there's one is kind of law of large numbers. So a lot of the emerging funds tend to be smaller, so less capital to return to get to multiples. And then I think some established funds get a little two things. One, kind of fat and happy, so some of the partners aren't as aren't quite as motivated as they might be earlier. So I think that's one. And then you also have infighting and politics that tend to happen with more established funds, as you're working together for a longer period. So yeah, I'd be interested in seeing that data, because I'm feeling something that contradicts that.
I think Ihar, you have some feelings on that one as well.
Yeah, I think that it's always important to understand what's the who are the people that they collected data from, right? And most importantly, they probably collected data from more like old school, really large established institutional LPs, rather than a vast majority of the LPs, right? So, and a lot of these large LPs had their own liquidity issues in 2022 and 2023, and some of them are becoming more risk averse in absolutely the most wrong time ever, right? So because right now, being risk averse meaning skipping the whole cycle when the environment is much more investor friendly, right? So, but what I'm sure that PitchBook does not capture LPs, that 70 LPs that invested in my fund, right? So, and most of the LPs that invest in other emerging managers that I know of, because a lot of what we see is that over the last several years, over the last 5 or 10 years, you have a whole new class of individual LPs that didn't even exist 10 years ago, right? And this is what drives a lot of VC ecosystem nowadays. And I think it's big. It's really important to support those LPs, and it's really important to understand that those LPs are not really supported enough by existing players in ecosystem like PitchBook, and not only not supported, but not polled and not covered and so on. But a lot of this, big tech employees or founders that are not, that don't even have their own family offices yet, like some kind of high net worth individuals, but not ultra high net worth individuals. And those people are investing in 2023, that's for sure. And those people are investing in emerging managers and not in established managers, because those people are not interested in middling, very predictable returns of a much more safer, larger funds.
Yeah, One of the things we always stress, I'll let you speak in a bit, is the concept of LP archetypes and trying to really target the people who are going to invest in you as opposed to wasting your time on like institutionals who, won't go for emerging managers at this stage. Alex, what would you like to add?
That's exactly what I was going to say. In this
Okay.
question, it's not sort of broken out. We say investing in new managers. Do you mean like their first fund, or emerging managers where it's like their second or third fund? Because that's a little bit of a difference. And then also that LP archetype. Are we talking about established institutional players? Because there's no way that they're going to be investing in a first fund new manager. And so you just wanted to make sure that we look at the nuances there.
We have a question from Rod for Barbara. What suggestion do you give for a founder thinking to move to the VC side?
Well,
repeat
yeah, it's good that you have a founder background, because starting your own fund is hard, and it's entrepreneurial. It's like starting a business. The time frame is much longer. So between you have an idea of a fund, you find your strategy and your partners, or even if you go solo GP, it's going to take a long time to gather the LPs and to structure the fund. When I started as a VC, not as an entrepreneur, I tricked my way up to be able to get the approval from the French SEC and all of that. And so the way I did it was by working as an advisor to specific startups that I really, really liked. And instead of getting paid, I was getting equity. And so this way I built a portfolio. And with this portfolio, then I managed to get the investors to build the first fund. And so, but initially I thought that in 6 months I was going to raise my fund and start investing into companies. But then I realized, well, no, it's much longer. So I hope it helps.
So you briefly touched on French SEC. I'm imagining with your company, Interstellar Lab, it's typically an industry where a lot of the funding comes from governments. How are governments looking at this, the current VC market?
So in our case, so the company, we raised 7 million total at seed stage through 2 rounds. Now we're raising Series A 15. Pre-seed was 1 million, then 6. And so pre-seed was mostly business angel. Then we got VC. Some of them actually went through VC Lab, like E2MC or Tomorrow's Capital, Saldor Capital. So I know if you guys are here, but saying hi. And so we didn't get that much governmental money. So we got governmental money on the French side to like 1 million to finance R&D, and then right now we're getting another 2 million to finance the pilot factory that we're building. So it's good. European governments, they have a lot of non-dilutive money to help funders invest in the capex. And then with NASA, it's a governmental contract, so it's like revenue. So I could have chosen to go like the governmental path and trying to raise money from them more, but I think the VC world and the stress also of having a venture capitalist at your cap table is forcing you as an entrepreneur to move faster. So I like government money when it comes alongside the private investors.
Right. Yeah. A lot of private partner, private public partnerships in that industry. Do you think that's a trend that will persist, or?
Well, so same. As an entrepreneur, I don't like to have all my eggs in the same basket. So governmental money is great. Private public partnership is a good way to finance when you have big capex and long-term vision of product, especially for space. In our case, we're generating revenue on the terrestrial application. So it's like you want to. And we moved faster to making revenue. That's what we were expected because of the crisis in 2022. And so back to, the successful startup that went through the crisis, you shall not bet on getting the money from governments, but like on finding customers.
Yeah.
So I see that continuing in the future, but I will not, again, rely completely on money from governments. They can take time to arrive to your bank account.
Oh, thank you so much. Emil is asking, do any of you have any tactical advice on quickly building credibility with individual LPs for them to sign pacts to?
Can talk about this a little bit because I
Alex?
just hear this. Yeah. I mean, the VC Lab program is awesome because this is a lot of the advice that I got that I wouldn't have realized. Adeo's been talking recently more about like how important it is to start with first and second degree connections because you've already built that credibility with them. You really have to go, it's like a founder going after friends and family, right? Like you got to start there before you go after angel networks and especially going after institutional VCs. Now there's been a lot more focus from Adeo on like, how do we actually go for like second to third degree connections? It's going to take longer. And there's rules around even talking, about what you're doing with these LPs, right? Who you don't know. You cannot talk about your fund. You can't say you're raising with anybody that you don't have a substantive relationship with. That's in the US specifically, but there's similar rules across the globe. And so, Emil, tactical advice, you're going to get that in VC Lab, first of all. And then secondly, what the brunt of it is you're going to have to build relationships with these potential LPs you don't know. And you're going to have to do activities that showcase yourself as an expert in the space and get someone, understanding what you're about and what you do. Before you actually go and make that ask. Ihar, I don't know if you have anything to add to that.
Yeah, perfect answer. I think, it's very important to keep focusing on people that know you, first of all, and then, get to know more people and for them to know about you, your track record, your investing experience, and everything, right? So, because that's in the end is what people make decision on, right? So it's not about, just trying to pitch somebody for 20 minutes, especially somebody you don't know. Doesn't work, and it's not appropriate according to the rules, right? So think about things, how you can establish yourself, right? So how can you reach out to people, but by offering advice or expertise or webinar, as opposed to just selling them and pitching them.
Yeah, I mean, I can give my perspective from the LP side, and it's definitely echo a lot of what Alex said in terms of building a relationship. It's a long-term process. It's very different from raising money for a startup, which is probably a little more transactional. There's again, with safes and convertible debt, you could be raising on an ongoing process for a startup, but it tends to be more of a one-time thing for this round and then the next round. Whereas for a fund, you're going to be raising that fund over 18, 24 months, and then you're going to have follow-on funds. So I may not invest in your first fund, I may invest in the second fund. So you're building that relationship, you're sharing what you're accomplishing, how are your early investments doing. So I will sometimes invest in the first close for fun, particularly for somebody that I've have a relationship with and want to support. But for somebody that that I've only met recently, then more likely to hang back and wait for one of the last closes, which means it's going to be hard to get a pack commitment early, at least for me.
Thank you, Steve. Switching gears for a moment, apart from our accelerator program, we have launched a new thing called Venture Institute, which is all about providing a more accessible door to the venture industry and preparing people for various jobs in the VC industry. And we have a question from the chat which ties into this. Someone's asking, with the VC market starting to pick up again and VC optimism rising, how does that impact career opportunities for people who want to join VC?
I mean, I think there's certainly more opportunities, now than any time in the past to get in and at different, different areas in a, VC fund, and there's more platforms and places again to get involved when you're maybe not, directly on the investment side. It can move over to the investment side. I think I had 5 or 6 of my students take the Venture Institute program, the first cohort, and had a good experience. And one of them, just took a hiatus from college to join VC Lab. So I think there's there are definitely opportunities to get in, and you probably want to be open to different opportunities within funds or organizations that may not be directly investing. And there's different paths too. Like Alex mentioned, he spent time at AWS, which is working with startups, and there's plenty of firms that have those types of roles where you're supporting startups and you can maybe make some investments and get in. But I think there's definitely much more opportunity now than there was in the past.
I can add to that, to people who are thinking whether it's a good time to start a VC or not. First of all, time in market beats time in the market, right? The earlier you start, the more track record you will have 3-5 years from now. And another thing is there is this important adage that it's the time is either easy to raise and hard to invest, or easy to invest and hard to raise. Now it's definitely easy to invest and hard to raise. The question is, do you want to start, which part of this is more important for you for the first fund, right? I personally would advocate is try to go through hard to raise part, but at least it's much easier to find good companies at decent valuations right now, and then be ready for a second fund. Maybe your first fund will be smaller if you start in downturn, but you will have better IRR and multiples. I don't envy anybody who did the first fund in 2020, 2021, suddenly got $40 million for their first fund, and then deployed it all in 2021, where pre-seed rounds were at 25 million valuations. They are now sitting at horrible negative IRRs for the 40 million funds, and they don't know how they can raise a second fund. So I personally would 100% prefer always to do a first fund in the downturn.
I think the question was, though, getting into VC at a non-partner level. So kind of how do you break in and
the overall job market for like venture partners and any type of VC role. So I'll rephrase it a bit. Do you feel like the industry is becoming more accessible to a broader range of people?
I think yes, mainly because there are more smaller VCs, right? All of the smaller VCs are like boutique firms that have like 2, 3, 5 employees. But at the same time, they all have vastly different requirements, vastly different approaches, vastly different geographies. Compared to 10 years ago, when there were way fewer VCs, they were much more consolidated in the Silicon Valley and such. And it was, if you don't get accepted, then it's really difficult because they wanted, Ivy League graduates and so on.
Thanks, Ihar. Does anyone else have anything to add to this topic? Okay, let's move on to another question. Stephen Price is asking, warm intros are always better. However, in this environment, it seems to be a numbers game. So what do you suggest for founders raising to get those initial conversations going? And then some more about cold outreach being tough.
I mean, it's always a numbers game with everything you do. Of course, warm intros are better, but it doesn't necessarily guarantee that what you have is going on. Are we talking about founders raising, or are we talking about getting into like a job in VC?
No, founders raising.
Founders raising, yeah. Yeah, well, the last thing I'll add there is that if you're talking to a lower level person at a larger VC, I tell founders all the time, they kind of get paid to go and find founders. And so that doesn't necessarily mean anything that someone's willing to take the meeting with you. If anything, they may be wasting your time. And so just like sales in any company you're going to be doing, you need to find that decision maker and make sure that you're convincing them.
Was the question about raising for a fund or raising for a startup?
I think raising for a fund, but
Okay.
No, wait. It was the word founder. So it's raising for a company, I think. So the question about raising for a company and cold intros, right? So,
founders
And-
raising. Barbara? Yeah.
Yeah,
feel free
I
to
did both,
introduce
and so it was
domain.
pretty much the same strategy. It's just the timeline is different. It's like you make your list of your like favorite investors and the people that can match your strategy, whether it's a fund or a company. Then you're trying to find the best connection. But I think it's the truth is it's true you don't want to lose too much time by talking to the wrong person, because if they too junior and they not the decision maker, 100% agree with Alex, you're going to lose a lot of time in both cases, LPs and VCs. I think you have to be very, very prepared, like, Excel sheet, and you go into like the machine mode, and then you email and you copy paste, be careful with the links when you copy paste. And then you have to get the machine going, because the thing is, I mean, especially in the startup world, like investors talk. So as soon as you're out and you're fundraising, you guys meet as investors, and you talk about your deal flow, and so it's like it's a strategy. You want to try to infiltrate everywhere, but also be careful, because if you go too fast and then you don't have the right strategy, and you start getting no's, then it's going to be hard to turn over. So, but I think it's the same when you're fundraising for a fund. It's like go fast, but not too fast. It's
Right. But time management is key. And I would be curious to hear some of all of your strategies there. Like, how do you manage your time properly, and how do you start building that machine, to use Barbara's words?
I personally think that it's important to set like KPIs on short and long term, right? So for yourself in terms of fundraising, right? How many yeses or signatures you want to get in a month, and then how many calls you want to get in a week, and then you go down to like how many emails you answer in a day, right? This kind of KPIs work for me, and as a VC, I wouldn't recommend cold outreach at all, but for a founder, I think it's a good mix of warm and cold outreach is good, right? So, and also it's totally fine to send a cold message to VC, and when they don't respond, try to find the warm intro to the same VC. I personally had this as a VC founder who first outreached cold and then found a warm intro and reached warm, and it works well. So I would say it's important to almost every day to send some emails. It's important to respond if anybody responds to you, because I think the biggest mistake, and I've seen it all over, when somebody reaches out to me, I respond and say I want to get a call, and then they disappear. That's the really, really rookie mistake, right? So another rookie mistake, though, if their email doesn't work, I think that's the funniest to me. They send me a cold message email, I respond and get an automatic like technical failure. Yeah, but try to make sure that if somebody responds to you, you really never drop the ball on them ever again, and try to make sure that you are getting them to the close.
Thanks, Ihar. That's immensely valuable for a lot of people. Does anyone else have time management strategies they would like to share?
Yeah, this has been a marathon. I think it's just like for raising or launching a new fund. And so like you really need to see it as that marathon. You're not gonna get a win every single day necessarily. And so I think, when you're launching a fund, you're both fundraising and you're testing out that fundraising strategy, but you're also trying to maintain your deal flow connections, and you're trying to still be in contact with the startups, because you need to have a pipeline of deals that, even though you don't have a fund, you need a pipeline of deals that you plan to invest in that are going to help you with the fundraising part that's there. Oh, and by the way, you're also creating the materials for your fund at the same time that you're going to need. And so all of that together is extremely hard. But what I found is that, you should protect your time for deep work, right? To be building some of these things and to reflect back on the activities you're doing. One of my mistakes I made in the beginning was just doing a shotgun approach to just talking to every single person in my network who could possibly be an LP. Even though I had an idea of the LP archetype a little bit, but I did too many meetings at once and it burned me out, and I really had a hard time mentally. So the last thing I'll say there is you need to protect yourself mentally. One of the tools that we got from the VC Lab Accelerator was this wonderful talk from an alum who talked about the importance of having like a visualization exercise every single morning as you're going into this period of extreme change in your life. If you're trying to launch a fund, right, you need to keep yourself grounded and centered. Remember why you're doing it, and most importantly, remember that you get to do this. This isn't something that's, you know, it's going to be stressful, but it's something that you have the opportunity and privilege to be able to do.
Yeah, to add to that, when you suddenly reach out to everybody you know at once, you burn possibility to reach out to them 3 months from now. One thing that worked well for me is spacing out, you know, so basically to make sure that every month for the foreseeable future, for a year or two, I have somebody new to talk to. And it's not only about mental health that Alex said, but also about that your fund will be in different situation, or your company as a founder will be in different state, right? So, and if you tell everybody one situation, like for example, your fund is new or your company is like pre-seed and has no revenue, then you will, the people will remember, everybody will remember your company is like this, and you will not have a chance to like, you know, to tweak your strategy or to tell, and then suddenly 2 months later, you have great news, right? So maybe you had the first revenue, maybe you got your first something really important. And you don't have anybody new to reach in your new stage, right? The new milestone. So I find it very, very good to have this kind of spacing out. I even now, like after I close the first fund, I still have a bunch of people who I didn't reach out to, and I will reach out to them with a message that, by the way, you know, you saw that we already raised the first fund in tech, you saw this in TechCrunch, you want to talk. And, you know, it's great. It's always great to have somebody new to reach out to around your first circle of contacts or second.
Yeah, you can only make a first impression once, right? So if you talk to your whole network when you're at a certain stage, that can burn future opportunities. That's very interesting. Ihar, you mentioned KPIs earlier, and we have someone asking for new managing partners, how can they measure success? Like, what are the key KPIs at early stages when you're raising a fund? And everyone feel free to tackle this one.
Basically, for me, first of all, getting on calls, right? Emails are easy. I think the calls is important. And second is, of course, number of commitments. I use the pact thing from VC Lab. You know, obviously, there are other ways to get commitments. So, yeah, I would say for the first weeks, at least a couple calls a week with new people, and then try to get a commitment every couple of weeks, at least, but maybe more, right? So maybe every week.
Barbara, as a founder, what are your KPIs to consider?
I'll try to reply as fast as I can.
Okay.
Well, for the Series A, I have a list of probably like 70 funds that I identified as a potential lead for our round, and I do on the first like 30 funds that will reach out and then do the back and forth. And then I'll add more, but I'll wait a little bit. Like I'm waiting for the feedback as well. And you don't want to go like the whole everyone right now and just like and just like ruin your fundraising strategy. But yeah, I'm trying to reply to everyone that got back to me before tomorrow. That's one of my key short-term KPI.
Nice.
I'll answer a slightly different but related question in terms of kind of what I think it's kind of what can the manager be doing. And as an LP, I'm looking, you know, first funds are really you know, on the manager's background. Second funds, you have logos. Third funds, you have actual track record. So, you know, what can you do to kind of accelerate that? So I like to see managers figuring out how to get operational. So, do you have a warehouse vehicle, or are there other things that you can show that you can actually close investments? So that will, kind of help get me interested. But again, that's kind of an answer to a different question than you asked, but I think one that may kind of help you at least see what are the activities that you can be doing to get LPs more interested.
Thank you, Steve. We have about 4 minutes left, and we do want to end this one on time. Let's quickly scan the chat for questions. Maybe final question. I'll generalize it a bit. What are recommendations for people, GPs trying to raise an impact fund in this current landscape?
I personally think that impact fund is really a great, adding impact to your strategy is a really great way to stand out in the current fundraising environment, right? So first of all, in the environment that is harder to raise compared to like 2020, 2021, it's important to stand out. And it's also important to understand that value of impact for LPs increases every day and every year, right? So even when I started 2021, it was way less front of mind compared to now. So I think that just don't be shy of putting it front and center, and really applying this and having examples from your track record when you were prioritizing impact without forgetting about financial returns.
Yeah, this may be a good thing to close on, which is what you touched on. How do you stand out in this current market as an investor, as a GP, or as a founder? Like quick, rapid fire answers, I guess.
I'm gonna jump in because I have to leave. Yes, I have to leave right now. How do you stand out? I don't know. It's gonna sound very cheesy. Is it what you say in English? But be yourself and be like genuine and honest. I think we are all radically different, and I really believe if you're doing this work, it's because you're passionate. So show your passion, and that's what's make you different from the others. Yeah, it's a bit general, but it's but I think it's true. You feel the real passion in investors and in founders, and when you feel that, then you can build the trust because it's human connection. So when it's true, then you build the trust, and then you build long-term partnership.
And thank you so much, Barbara. And thank you for your
to
time.
add to Barbara to that it's about focus and about being talking about the same area again and again, right? So for example, if you invest in, I don't know, impact, first talk about impact all the time on LinkedIn and your discussion with founders and your events and so on. If you're talking about consumer apps, make sure that everybody knows you as an expert on that, right? So basically, in order to stand out, have a focus and continue on this focus for a while.
Thank you, Ihar. Alex, how do you stand out?
Yeah, I was just going to echo what they said. Just back to the basics, the fundamentals that are common sense, but it's, common sense isn't always that common. Number one is earn that trust with every single founder you interact with, right? Have that great reputation. You're going to get those inbound referrals for the greatest deals when, maybe many investors won't. And then, as Ihar said, sticking to that unique insight, that reason why you built this fund that made you think that you're going to be successful in this. Stick to that unique insight so that you can find those diamonds in the rough, even during a market like this, right? Because at all times, like finding those great deals when no one else even sees them is the way to go.
Lastly, Steve, any advice on standing out?
Well, again, I'll take it from the other side because I have fund managers that are trying to stand out. So I communication, sharing data, not necessarily going for that hard sell. and kind of, building that over time. So I have a number of, fund managers that I've been in conversations with for, many months or longer. And, I do like getting updates, see what you're working on, understanding what I'm interested in, helping me out there. So that's kind of what I look for, and, kind of building a long-term network. I think that's an important thing. It's something to recognize, even if you feel like you always need to be selling, don't necessarily be in, kind of full sales mode.
Right. Yeah. The importance of authenticity, I guess,
Yeah.
has been stressed by everyone. And on that note, thank you all for being your authentic self on this call. This was a great session. Thank you for being here.
Yeah,
Thank you,
thanks.
Neil.
That was fun. Good to meet you guys.
Thank you, everybody. Good to
Having
meet
me.
you. Thank you for the questions.